So today we are going to be looking at risk and uncertainty. In our last class, we discussed adjusted present value, and we're able to solve only one illustration, which I told you, as you can see, it took us a longer period for us to be able to complete the question because of the need to explain all relevant concepts while solving the question. That notwithstanding, and I also mentioned that today we are going to be starting risk and uncertainty. So this class will take us for the next 2 to 2.5 periods. Okay, we are going to have about 2 or 2.5 periods to complete risk and uncertainty. We have specific scope of risk and uncertainty that we are going to discuss. All right. The first one would be, okay, let's just go straight. Yes, risk and uncertainty. One thing you need to understand is that every businesses or even individual will take some level of risk, and also even the future has some kind of element of risk. Okay. So, and it is important, it's only important that we consider risk and uncertainty when evaluating a project. Businesses involved, or businesses operate in an environment that involves the element of both risk and uncertainty. This is because the cash flow estimate, including market demand, budget, plan, and the forecast figure, may be different from actual due to some external factors, including market, economic, legal, or political environments that may impair the ability of a company to take advantage of market condition or to achieve its intended goals. All right. And that's why it is essential for any decision maker to incorporate the element of risk and uncertainty involved in the variability of cash flow when determining or when carrying out investing decision. Okay. Generally in finance, all right, in finance, risk and uncertainty are used interchangeably, even though technically they are different. But as far as investing decision is concerned in finance, we use risk and uncertainty interchangeably. So if that is the case, what do you understand by risk? Risk is a situation whereby future outcome is unknown, but it can be predicted with the elements, with the past experience and probability of occurrence. Okay? When you are using past experience to project what the future outcome will be, that is a risk. Say, for example, as a company, let's say in 2024, we made sales of about 100 million naira, for example, right? Now we are planning, or we are preparing our budget for 2025. So based on the fact that we were in the market in 2024 and we achieved 100 million naira sales. So we can say, to a large extent, we can predict what 2025 or how 2025 will look like. We can say, okay, if we're able to make sales of 100 million naira in 2024, we should be able to do 10% or 20% of what we did in 2024. That means we are using our past experience with the help of probability to project what the future outcome will be. That is a risk. Not only that, risk is an event whereby the original investments or part thereof may be eroded. You know, when you commit your financial resources into an investment, there is no guarantee that you are going to get your money back because market condition may erode that investment. All right. You recall what happened in 2008 during the economic meltdown. Stock market crashed, whereby almost all investors lost money during the period. All right. That's a risk. A risk is a situation whereby, and as an investor, you may anticipate that you are going to earn 10% return on your investments. Due to market condition or economic factors, you may not earn the 10% you anticipate to earn, maybe less. The actual may be different from what you projected to achieve. That's a risk. All right. So, and that's why it is important for us to incorporate risk in the cash flow estimate. So that is as per risk. Then uncertainty involves a situation whereby future outcome is unknown and it cannot be predicted with past experience and probability of occurrence. Okay, when you cannot use past experience and probability to project the future outcome, then that is what is known as a risk. Okay, so now you know the difference between the two. What are the methods of hedging risk and uncertainty? All right, what are the methods of hedging risk and uncertainty? We have a host of them, but I will only mention few. All right, and then out of the 14 you have in this list, on this list, about 5 or 6 of them is what we are going to discuss. All right, I don't think at this level examiner can ask you to list the method of mitigating risk and uncertainty. But in any case, it's good for you to know. One is shorter payback period, right? We have discounted cash flow payback period, discounted payback period. You know all of this. We have accounting rate of return. What do you mean by shorter payback period? Under the shorter payback period, management will want to know for us to be able to undertake a project. So management will have its own targeted payback period. So if the project is able to meet up with the management targeted payback period, then that means the project is good. We should consider it. Under the discounted cash flow payback period, of course, you are supposed to discount the cash flow instead of using the normal cash flow. So you discount it to the present value equivalent before you calculate the payback period. That notwithstanding, you still need to benchmark with the management targeted payback before you can know whether the project it should be considered. All right, so you know all of this up to accounting rate of return. Let's talk about risk-adjusted method. The risk-adjusted method is also a method of hedging risk, such that you are supposed to use risk premium. You are going to add risk premium to the company's weighted average cost of capital to appraise a project. Say, for example, a company's cost of capital is 10%. You may be given a risk premium of, say, 5%. So instead of using WACC, okay, instead of using WACC only to discount the future cash flows, you are going to add the WACC with the risk premium, okay, with the risk premium. The addition of the two, which is 15, is what you are going to use to discount the future cash flow that the project will generate. So that's what you need to do under the risk-adjusted method. Therefore, if the project NPV using the combination of the WACC and the risk premium, if the project produce a positive NPV, that means it is financially viable. then the project should be undertaken. All right. So that is what you need to do under risk-adjusted method. All right. Then the number 5 is certainty equivalent method. The certainty equivalent method is also a method designed or is a method that relies heavily on equivalent factor when appraising a project. So whenever you want to calculate net present value using the certainty equivalent method, you are supposed to multiply the cash flow generated by the project with the certainty equivalent factor and then the discount factor in determining the present value. Okay, so you are supposed to multiply to get the present value. You are supposed to multiply the cash flow. You multiply with the equivalent factor. Okay, we multiply with the equivalent factor, then also with the discount factor. So that will give you the present value for each year. Then you now sum everything, you less it from your cash outflow, you have your NPV. So the difference between equivalent factor, the difference between certainty equivalent factor and the risk adjusted is that, of course, the two of them, you are supposed to calculate NPV. But this certainty equivalent method, you are multiplying your cash flow with the equivalent, that equivalent factor, or what we call coefficient, is to reduce the variability in the cash flow, to adjust for the variability in the cash flow. All right. So that's basically that. Of course, I can't talk through all of them. We are going to focus on the one we are going to really discuss. All right. So you can just read through. Of course, we also have triple assessment method. We have conservative estimates. We have finite horizon. We have expected value. We are going to discuss that, very common in ICAN. Then also another method is a standard deviation, variance, and coefficient of variation. Again, we are going to discuss this. Then we have simulation. We also discuss this. We have sensitivity analysis. We will discuss this. We have decision tree. All right, we also discuss this. Then, of course, there is also capital asset pricing model. You're already familiar with this. All right. So let's start. We are going to start our discussion around expected value. We're starting with expected value. Okay. Yes, somebody was sending message. Let me check through. Is it the same as adding inflation? It's not inflation. All right, Charity. You are not adding inflation. It's not certainty equivalent. It's not the same thing as inflation. All right. Okay. So let's talk about expected value. What do you mean by expected value? Expected value is also known as mathematical expectation or Bayesian theory. Okay, we can call expected value. We can call expected value as mathematical expectation or Bayesian theory. Somebody will ask me, what do you mean by Bayesian? Bayes, you remember, in statistics, we have what we call Bayesian theory. You can call expected value Bayesian theory or mathematical expectation. It involves averaging each possible outcome. Okay, it involves averaging each possible outcome. And then expected value is computed by multiplying the probability of each state of nature with the associated possible outcomes or with the cash flows. So to get expected value, you are supposed to multiply probability with a cash flow. Okay, so that is how to calculate expected value. I repeat, to calculate expected value, you are supposed to multiply cash flow at each state of nature. You multiply with the cash flow. All right, you multiply probability at each state of nature with the cash flow. When you talk about state of nature is the event in the economy. All right, state of nature is the events in the economy. In the economy, you can have high demand, high demand or low demand. You can have good, bad, worse. The economy, you can have a boom in the economy. You can have a recession. You can have above, below, or average kind of demand. You can have optimistic, most likely, or pessimistic. So those are the states of nature. Like I said, the states of nature are the events in the economy. All right, because oftentimes, as examiner may not give to you the probability of occurrence, but once you can see state of nature in the question, all right, then, and also you are given a value attached to the state of nature. So you can use that value to determine your probability. Okay. So generally, the expected value method is mostly preferred by the risk neutral individual investor, manager, or decision maker, because as a risk neutral investor will accept any outcome irrespective of the market condition or the state of nature, either good or bad. A risk neutral will always accept any outcome under any condition. Okay. Therefore, so like I said, to calculate expected value is denoted as X bar, and it is computed as summation of probability of X. That is, just multiply probability with the cash flow. P is the probability, X is the cash flow. So to get expected value, just multiply probability with the cash flow. That's all you need to do. It's as simple as that. All right? Now, one more thing under expected value. Examiner can ask you to calculate expected NPV. You may be asked to calculate expected net present value, okay? The expected net present value is calculated the same way as the normal net present value, except that expected value should be used to calculate the expected NPV, okay? Let me put it down for you because I'm not sure, it's not in this material. Like I said, the expected NPV is calculated the same way as the normal NPV, except that expected value is used as the cash flows, or except that expected value is first calculated and then used. Let me write that. And then used as the cash flow when computing NPV. Okay, when computing NPV. So when you want to, anytime you want to calculate the expected NPV, the first thing you need to do is to calculate expected value. You then use your expected value to go and calculate NPV. The result is known as expected NPV. All right, so that's different between the two. In most cases, examiner will ask you to calculate expected NPV, so you should know what to do. All right, so at this point, before we move to standard deviation, let's have illustration. Let's have illustration. Let me see. I think I have a question that relates to expected value alone. 30 marks question. Let me see. What is here? I think this is it. You are required to analyze. Yes, this is the question. I need one of you to help us read. Who is helping us?
Okay.
Who is helping us to read?
Let me read, sir. Can you hear
Okay, go
me?
ahead. Yeah, I can hear you.
Okay.
Where's consulting?
Is it
Yeah, let me
this?
scroll up. Lewandowski.
Okay. Illustration one.
Go ahead.
Lewandowski PLC, a manufacturing company located in the eastern part of the country, designs and manufactures personal stress monitoring device (PSMD). The device has a commercial life of 3 years. As a result of wide advertisement campaign, the company recorded high sales for the 2 years, while the sales figure for the third year went down sustainably due to low demand for the products. The marketing department of the company was assigned the responsibility of finding out the reason for the low demand. The department discovered that the consumers complained of the low quality of the product, which makes it less durable. With this information, the company decided to submit 200 samples of the devices to the Quality and Assurance Department of the company for analysis. Out of the 200 devices submitted, 50 enjoyed an above average demand, 120 enjoyed average demand, and the remaining 30 enjoyed below average demand. This demand pattern is applicable in all the company's products. Recently, the company developed a new device known as Simple and paid 10 million naira as development costs. The following projections were made in respect of the product Simple. Variable costs will amount to 30% of sales. Sales revenue and variable costs will be received and paid respectively on the last day of the year in which they arise. If Simple is produced, a special machine will have to be purchased at the beginning of year one at a cost of 190 million naira, payable at the time of purchase. The machine will have a scrap value of 10 million naira at the end of the product's life. The amount is receivable 1 year after the last year in which production takes place. If purchased, the machine will be installed on an unused part of one of Lewandowski's PLC's factories. The company has been trying to let this unused factory space at a rent of 60 million naira per annum. Although there seems to be no chance of letting the space in year one. There is a 60% chance of letting it for 2 years at the beginning of year two and a 50% chance of letting it for 1 year at the beginning of year three, provided that it has not been let at the beginning of year two. All rental income will be received annually in advance. Fixed costs, which includes depreciation of the special machine on a straight-line basis, are expected to amount to 70 million per annum. These costs, which are all specific to the production of Simple, and with the exception of depreciation, will be paid on the last day of the year in which their advertising expenses will be paid on the first day of each year, and will amount to 30 million naira at the start of year one, 20 million naira at the start of year two, and 10 million naira at the start of year three. Lewandowski PLC has a cost of capital of 20%. You are required to analyze and evaluate the production of Simple based on expected present value. Show relevant calculations.
Thank you very much. Who has consulting? Appreciate. Now, examiner is asking you to analyze and evaluate the production of Simple based on expected present value. So you want to calculate expected NPV. What are you supposed to do? Now, because examiner has mentioned expected present value, it means that you have to calculate expected value before you can calculate NPV. All right. So, and for you to be able to calculate the expected value, you must be given cash flows, you must be given probability. But when you look at this question, for your cash flows, we are not given probability. These are the revenues, these are the cash flow given to us at each state of nature. We have three states of nature in this question. One is above average demand, 2, average demand, then 3, below average demand. Those are the 3 states of nature. However, ordinarily, each state of nature is supposed to come with a probability. But in the question, we are not given a probability. Since you are not given a probability, how will you be able to calculate your expected sales? Because the essence of probability is to reduce the variability in the cash flow. All right, is to adjust for the variability of the cash flow. So now that you are not given, then in that case, you need to go to the question and identify, because since it is not given to you directly, that means the examiner has hidden it somewhere. So you should be able to unravel it. All right. So I will then go back to the question and check where I have information on the samples given to us. When you look at the second paragraph, examiner told you that the company decided to submit 200 samples of the devices to the quality and assurance department of the company for analysis. Out of the 200 devices submitted, 50 enjoyed above average, 120 enjoyed average demand, then the remaining 30 enjoy below average demand. So that means for me to be able to get my probability under the above average, I will divide 50 for above average. I will divide it by the total sample of 200. That will give me the 0.25. That will be the probability of above average. Again, to get the average demand, 120 divided by 200, that will give me 60% probability. Then the last one, which is 30 over 200 sample. So that will give me like 15. All right, that will give me like 15. Okay, at the end of the day, I will get my probability. Once I get my probability, I will then multiply with the sales revenue for each year. All right, so that I can get my expected sales. Once I have the expected sales, there is a variable cost of 30% of the expected sales. So if variable cost is 30%, it means that contribution will be 70%. So I can decide to calculate expected value. Once I get my expected value, I will then multiply by 30% to get variable cost, to get expected variable cost. If I don't want to follow that route, I can say, okay, after calculating my expected sales, then if variable cost is 30%, then contribution will be 70%. I will just multiply 70 with the expected sales. I will get my expected contribution. Then thereafter, any other cash flow I have in the question that has nothing to do with probability, I will continue to minus or to add it. So this is what you are supposed to do. Quickly, let's solve this illustration and then move to the next one. All right? Let me stop sharing. Let me share the working notes. Okay. Solution. This is solution to illustration number 1. Page that should be page 62. Please, when you are faced with this kind of a question on the day of your exam, you have to shine your eye. Don't rush. All right? Don't rush. This is a compulsory question, 30 marks. So that means you cannot run away from the question. You have to attempt it. Therefore, when you are solving it, don't rush. Ensure you understand the scenario and you interpret it accordingly. Because if you interpret each scenario wrongly, certainly you can't earn your full mark. And that's why it's important for you to digest it before you put your pen to paper. So the name of this company is Lewandowski PLC. Examiner is asking you to calculate expected NPV. I would then say calculating expected present value or net present value. Our figures, let's restrict our figures to million. I think examiner even mentioned, let me go back to the question. Was it mentioned? No, we are not told. All right, so you are at liberty to either use, but in the question examiner use million. So you are at liberty to use any, whether you like, you can, if you like, you can write it out in full. If you like, you can restrict it to million or thousands. So you are good. No specification. So I will then go back to the question, what is the useful life? I want to design my table. What is the useful life of this project? This project has 3 years life, okay? So that means I need to create about 4 columns or 5. However, there's a specific instruction in the question or information in the question that relates to scrap value. Examiner told us in the question that in the, I think in the after second paragraph after the sales revenue, the paragraph after the variable cost, you are told that the machinery will have a scrap value of 10 million naira at the end of the product's life. You know, ordinarily, scrap value is supposed to be after the project's life, that is at the final year. But examiner specifically told you in this question that the amount is receivable 1 year after the last year in which production takes place, which means that this 10 million naira scrap value will not be received in the 3rd year until the 4th year. So that means we are going to extend by 1 more year. But the reason why I'm emphasizing on this before, the reason why I call your attention on this is the fact that because when you are when you are under exam prayer, there's likelihood that you might have forgotten because all along your mind is that, okay, your mind is already fixed that scrap value is always at the end of the useful life. All right. Meanwhile, examiner has told you that this amount will not be received until 1 year after. All right. So unknowingly, you can just pick that 10 million and put it in year 3 instead of year 4. When you do that, you are going to get it wrong. All right. So that's why you have to shine your eye. Okay. In any case, let's move on. So we are going to create 4 years. We do for year 0, year 1, year 2, year 3, year 4. If we like, we can include workings. Okay. So I will then go back to the question. This first page is for our main solution. Then the second page will be for our workings. So like I mentioned to you in the question, examiner did not give us probability. First thing first, you need to compute your probability. So probability all right. How do we get our probability? We are going to pick the state of nature as given to us. We do workings for our probability. Then whatever the answer that we have, put it here. We have 3 states of nature: above, average, average, then below, average demand. Okay. Then we do workings for our probability. So, according to the question, we are told that 50 out of the 200 samples collected, 50 enjoyed above average. Therefore, to get the probability for above average demand, it will be 50 divided by 200. So let me use my calculator. I think that's 0.25. 50 divided by 200. Yeah, that's 0.25. 120 enjoyed average demand. Therefore, 120 divided by 200, that should be 60. Let me confirm. 120 divided by 200. Yeah, 60. 0.60. Then 30 enjoy below average demand. Therefore, 30 divided by 200 will give us 0.15. When you add it up, your probability must be equal to 1. At all times, your probability must be equal to 1. Okay? So if that is the case, now that we have the probability, we can then proceed to calculate expected sales. Working number 2. We want to calculate expected sales. Why are you calculating expected sales? Because the sales value given to us for each year are attached to state of nature. There's a probability attached to each state of nature, and that's why you have to compute expected sales. Okay, so to get the expected sales, you are supposed to multiply probability at each state of nature with the expected sales for each year. So I will create a column for state of nature, another column for probability. Then for the cash flows, I need cash flow for each year. So here will be year 1. This one will be year 2. Then I will have year 3. Under each year, we have cash flow and then expected value. Cash flow, expected value. Cash flow, expected value. Under states, I have above, average, then below average. These are the 3 states of nature. Let me arrange my table properly. Okay. Let me withdraw that. What's wrong with you? All right. I want to get my table ready. Okay. Now that I have my table ready, I need to input the probability. Here is 0.25, 0.60, 0.15. Give me the cash flow for year 1 at each state of nature. What's the cash flow of year 1?
240,
240,
140,
140,
50,
50. For year 2,
500, 340,
and then
180,
180. Year 3,
160, 80,
and then
50.
50. So these are the cash flow given to us at each state of nature. So now get the expected value. Remember, we said that expected value denoted as X bar. Okay, our X bar is equal to summation of probability of X. That is, you are supposed to multiply probability with the cash flow. So in this case, for year 1, 0.25 multiplied by 240, 0.25 multiplied by 240.
60.
This will give us 5. What did I do? That would be 50.
60.
0.6 multiplied by 140.
It's 60, sir.
Pardon?
60, the expected value for year 1.
Oh, okay, yes. 60. I was doing a 200. Okay. The next one,
84.
84. The last one,
7.5.
7.5. So when we add it together, we are going to have 144, 151.
151.5.
0.5. So that's the expected sales for year 1. I will then move to year 2. 0.25 multiplied by 500. Yeah,
125.
125. 0.6 multiplied by 340.
204.
204. 0.15 multiplied by 180.
27.
27. Again, we had the 3 of them together.
356.
356. We then do for year 3, 0.25 multiplied by 160.
40.
40. 0.6 multiplied by 80. That should be
48.
48. 0.15 multiplied by 50 will give us 7.5. So we add it up. That's 90, 88. That's
95.5.
95.5. Okay. Now that we have computed expected sales, we can then proceed. Like I mentioned to you earlier, if variable cost is 30% of the expected sales, then contribution will be 70% of sales. So I can either decide to carry all this cash flow of each year, 151.5 million, 356 million, as well as 95.5 million. I can carry that one and put it in my table of NPV. Then I will less variable cost of 30%. Or instead of doing that, I can just multiply. If variable cost is 30% of sales, it means that contribution will be 70%. So that will save time. Therefore, I will follow that route. So you are going to give me the expected sales for each year. The first one is 151.5. So I will then say contribution at 70% of sales. Okay, let me reduce it. Contribution at 70% of sales. The sales in the first year is 151.5. Okay, 151.5 multiplied by 0.7. That's 106.05. 106.05. If you like, you can do your working separate for that. No worries. Well, I don't see any reason for doing that. Then sales for year 2, expected sales of year 2 is 356 multiplied by 0.7, 70%. That's 249.2. 249.2. Then for year 3, 95.5 multiplied by 70%. We have 66.85. 66.85. Okay. The next item, I will then go back to the question. Now that we have determined our cash inflow, we need to go back to the question and read the scenarios all through again. We are done with contribution. We are now told again that if simple is produced, a special machine will have to be purchased at the beginning of year 1 at a cost of 190 million naira, payable at the time of purchase. That represents the initial outlay. The machine will have a scrap value of 10 million naira at the end of the product life. Okay, the amount is receivable 1 year after the last year in which production takes place. So that will come much later. Our scrap value is 10 million naira. That will come later. Okay. Why do you want to do contribution for 3rd year, the charity? After my explanation, I told you the only reason why you push to the 4th year is because of scrap value. The project life is for 3 years, so you can't do contribution for the 4th year. All right. Okay. So we are coming back for scrap value later on. The amount, okay, I've read that. If purchased, the machine will be installed in an unused part of one of Lewandowski PLC's factory. The company has been trying to let the unused factory space at a rent of 16 million naira per annum. Although there seems to be no chance of letting the space in year 1, there is a 60% chance of letting it for 2 years at the beginning of year 2. Pay attention to this scenario. This is what examiner has hidden in the question. If you don't know, if you cannot interpret this scenario correctly, your final answer will be wrong. Therefore, pay attention to how we are going to treat that information on opportunity cost. So examiner told you there is an unused factory space that worth 16 million naira. Currently, the company has not been able to let it out. They have not been able to rent out that unused space. However, that same space is where they are going to keep this equipment or this machine. So that means they cannot rent it out. However, examiner is now telling you that there is a 60% chance. Chance is the same thing as probability, right? So there's a 60% chance of letting it for 2 years at the beginning of year 2. Beginning of year 2 means end of year 1. Beginning of year 1 means year 0. Beginning of year 3 means end of year 2. So if you have been told that there's a 60% chance of letting it at the beginning of year 2 for 2 years, so that means you are supposed to take 60% of the rent of 16 million naira for 2 years. By the time you multiply 60% of 16 million, you should have something around 9 point something million. So for 2 years, that means out of 100% probability, 60% is gone. You are left with 40%. Examiner also told you that and a 50% chance of letting it for 1 year at the beginning of year 3. Beginning of year 3 means end of year 2. Provided it has not been let at the beginning of year 2. 50% has not been let at the beginning of year 2, so that one is out of it. All rental income will be received annually in advance. So in this case, that 50%, remember, probability must be equal to 100%, that is 1. So if you have left out 60% at the beginning of year 2, which is end of year 1, you are left with 40%. But examiner did not mention 40% in the question. The second part, examiner mentioned 50%. By the time you have 60, you had 60% and 50% together, it will be more than 100%. So what examiner expected you to do here is to multiply 50% of the balance of the 40%. for the second year rent. So that's what you need to do. Without wasting more time on this, let me go ahead and do working for that. We have opportunity cost on rent, working number 3. Opportunity cost. On rent. Okay. So in this case, I will create a column for year 1, year 2, and then year 3. All right. So my probability will be here. Probability will be here. Then workings. Okay. Now, the first one is 60%. The first probability is 60%. So 60% is the same thing as 0.60. 0.60. Then for my working, this will then be 0.60 multiplied by 16 million for 2 years. For 2 years, this will give me 9.6, 9.6. Remember, this 60% is at the beginning of year 2. And we said that beginning of year 2 is end of year 1, because you have to count 12 months before you can recognize a year. So if beginning of year 2 is just maybe a day is not up to a year. So we cannot recognize year 2 as a full year. We cannot recognize the beginning of year 2 as a full year. So it has to be end of year 1. And the examiner said that you are going to let out that 60% for 2 years at the beginning of year 2. So that's the interpretation. We have done that. Okay. Let me close this. All right. Also, you are told that and a 50% chance of letting it for 1 year at the beginning of year 3. Beginning of year 3 is the same thing as end of year 2, provided it has not been let at the beginning of year 2. So there's a 50% chance. So when you had 50% plus 60%, that will give you 110, which is not correct. So you are expected to do 50% of the balance of 40 of the balance of 100%. You know, this first one, out of 100% probability, you have let out 60%. You are left with 40%. Therefore, you are supposed to take 50% of the balance of 40%. So this will give you 0.20. You then say 0.20 multiplied by 16 million. This will give us 3.2. This 3.2 is the end of year 2, because beginning of year 3 is end of year 2 for 1 year only. Dash. Here will be 3.2. Now, when you look at the probability in this table, our probability is just 0.8. 0.6 plus 0.2, that's 0.8. So our probability is not balanced. Therefore, to make your probability balance, you then say 50% of the balance of 20% multiplied by 40. This will give us 0.20. With this, your probability is now equal to 1. Okay. All these ones are dashed. You are not calculating range for this third line. You are not calculating range for the balance of the probability of 0.2, because we have nothing. Just the essence of that point, last 0.2, is to ensure that your probability equal to 1. It has nothing to do with your calculation. All right. So here will be 9.6. Here will be 12.8 dash. So our opportunity cost on rent is 9.6 and then 12.8. Let me complete my table. All right, so let's go and post. Opportunity costs. The first year is 9.6, it's a cash outflow, then 12.8. That's working number 3. Then we go back to the question. Any other information? Yes. Still on the same paragraph. We are told that fixed costs, which include depreciation of the special machine on a straight line basis, are expected to amount to 70 million per annum. These costs, which are specific to the production of simple and with exemption of depreciation, will be paid on the last day of the year. Okay, so we have a fixed cost of 70 million naira, and we are told that these fixed costs include depreciation. Let's go and work it out. You will recall when I was explaining under capital budgeting, I mentioned to you that there are 3 ways examiner can test you on fixed costs. I said if you are given a fixed cost, no additional information, that fixed cost is not relevant. 2, if you are given a fixed cost including depreciation, I also said that the fixed cost is not relevant. However, you have to calculate annual depreciation and less from the fixed cost. Whatever you have thereafter is relevant. So in this particular instance, examiner has told you that the fixed cost of 70 million naira include depreciation. So we need to calculate annual depreciation in this case. I would then say fixed cost 70 million. We need to calculate annual depreciation. You know, depreciation is costs minus scrap value divided by useful life. Okay, so the cost of this machine is 190 million minus scrap value of 10 million divided by useful life of 3 years. So 180 divided by 3 will give us 60 million. Therefore, 60 million minus 70 million will give us 10 million. Our specific fixed cost is 10 million naira per annum. Okay, so let's go and post. Fixed cost. Working number 4. 10 million naira per annum. Let's go back to the question. After fixed costs, we are also told that there's an advertising expenses. We have advertising expenses. We are told that these advertising expenses will be paid on the first day of each year. First day of each year means beginning of each year. So that means the advertising expenses of 30 million naira at the beginning of year 1. Beginning of year 1 is year 0. So the one of 20 million at the beginning of year 2 is end of year 1. The one of 10 million at the beginning of year 3 means end of year 2. Okay, so let's go and indicate that. Adverts. Expenses. 10 million naira, 30 million naira at the beginning of year 1. And I said beginning of year 1 is beginning of year 1 is year 0. So here will be 30. It's an expenses, cash outflow.
Sorry, we cannot hear you.
Hey, sorry. When I log in again, I was muted. I didn't notice that. Thank you for that observation. Thank you. Sorry, what I was trying to say, under advertising expenses, because we are told that advertising expenses is at the beginning of each year. So the 30 million naira is at the beginning of year one. Beginning of year one means year zero. And that's why you see that 30 million naira at year zero. 20 million is at the beginning of year two. Beginning of year two means end of year one. So that's why you see 20 million in year one. The 10 million is at the beginning of year three. Beginning of year three means end of year two. That's why we are seeing 10 million at the end of year two. Then the scrap value. The scrap value we are told, the scrap value of 10 million naira, we are told that it will occur at the end of year three, which is the final year. But we are told in the question that 10 million naira will not be received until 1 year after. And that's why we are seeing that we indicate the scrap value in the 4th year. All right. So again, like I said, this question does not involve taxation, and that's why we are treating it this way. Otherwise, we would have stopped at advertising expenses. We get the profit, we apply tax, we consider tax saved on capital allowance, then we consider scrap value, all those things you normally do when you are calculating your NPV. Now, the next one is initial outlay. According to the question, initial outlay is 190 million. Cash outflow. No working capital in the question. So at this stage, we need to get our net cash flow. So here will be 220 million. Then here will be 56.85. Here will be 10 million. Then for year one, it should be 106.05.
66.45.
Pardon?
66.45.
66.45. Okay. Are you sure it's 66? Yeah, it should be. It should be, yeah. 66.45. All right. Then year two. What about year two?
216.4.
216.4. Okay. All right. So now that we have the net cash flow, we then need to discount it at the appropriate cost of capital. In the question, we are given a cost of capital of 20%. So at 20%, in year zero is 1. Then 20% discount factor in year one, 1.2. 1.2 raised to power 1 minus equal 0.833. Then for year two, 1.2,
0.694.
0.694. Year three,
0.578.
578.
Or 9 now,
Then
approximately.
579. Then year four,
0.482.
482. So we need to get the present value. Year four will be 4.82. Yeah, 0 is 220. Yeah. This is the present value.
Year 1, 55.35.
55.35.
Year 2, 150.18.
150.18. 56.85 multiplied by 0.579.
32.92.
32.92. We then add up the positive present value with less 220. What's the balance? 4.82 plus 32.92 plus 150.18 plus 55.35 minus 220. What you get?
23.27.
23.27. This is the expected NPV. That's end of the question. I would then say the expected NPV is approximately 23 million naira, or is 23,270,000 naira. That's it. That's the end of the question. You can see the question looks small, but if you misinterpret the scenario, certainly you cannot earn your full mark. You can imagine 30 marks for that matter. All right. So you have to be very careful when you are picking your numbers. Ensure you interpret the question correctly before you put your pen to paper. Okay. So let's move on to standard deviation. Let me know if you have any question on this before we switch. So let's talk about standard deviation. What do you mean by standard deviation? Standard deviation is a statistical measure of absolute dispersion and is a measure of spread about mean value. Standard deviation is used to measure the risk inherent in a project. And the higher the standard deviation, the more risky is the project. Okay? The higher the standard deviation, the risky the project. Where two or more projects or alternatives are being considered, any project with a lower standard deviation should be selected because you want to minimize your risk. Okay, I take it again. Standard deviation is a statistical measure of absolute dispersion and is a measure of spread about mean value. It is used to measure the risk inherent in a project. And I said that where two or more projects are being considered, any project with a lower standard deviation should be selected. Okay. Of course, the higher the standard deviation, the risky the project. All right. How do you then compute standard deviation? If you are asked to calculate standard deviation, because you have to be careful, there is difference between standard deviation and then standard deviation of expected NPV. All right. So if in a question you are asked to calculate standard deviation is just the square root of variance. Square root of variance. To calculate variance is summation of probability of x minus x bar squared. So to now get standard deviation, you are supposed to just find the square root of the variance. This is called this is the formula for standard deviation. Okay, that is the formula for standard deviation. All right. Now, examiner may ask you to calculate standard deviation of expected net present value. How do you do it? To calculate the standard deviation of expected NPV, You can use either of the following formulas depending on whether the cash flow is, whether you are given mutually dependent or independent cash flows. All right. So where you are given mutually dependent cash flow, first thing first, what is a mutually dependent cash flow? A mutually dependent cash flow is the one in which the events in each year are the same. Let me put it down for you. Mutually dependent cash flow. Mutually dependent cash flows are cash flows in which the events of each year are the same. So what that means is that when you talk about mutually dependent cash flow, if in the question you are given a cash flow for all relevant years, let's say, for example, year 3, year 1 to 3, and across all the 3 years is the same cash flow. Because they are the same cash flow, that means they are mutually dependent. So the same event that will affect year 1 cash flow is the same event that will affect year 2 cash flow. So it means they are mutually dependent. So where you are given mutually dependent cash flow, an examiner is asking you to calculate standard deviation of NPV. Examiner will not tell you they are mutually dependent. It is implied in the question. Examiner expect that you know it. So they will not tell you that it is mutually dependent. Once you can see that the cash flow of each year are the same, year 1, year 2, year 3 is the same cash flow, it means that they are mutually dependent. Once the cash flow are the same, that means. So like I was saying, provided the cash flow of each year are the same, then it means they are mutually dependent cash flow. Year 1, year 2, year 3, year 4, continue. So if the cash flow are the same across all relevant years, it means they are mutually dependent. So if they are mutually dependent, and you are now asked to calculate standard deviation of NPV, in that case, the standard deviation of NPV will be computed as the standard deviation multiplied by annuity factor. Okay. Or you can say standard deviation of NPV equal to summation of standard deviation computed over 1 plus r raised to power n. Okay, so that's that. These are the either of the two, whichever one you use, we are going to get the same answer. Because when you say this denominator, the denominator you have here is discount factor of each year. So by the time since the standard deviation is constant, since your standard deviation is constant, therefore it's better you just calculate annuity factor and you get your answer. All right. But if you want to do it one by one, so be it. So that means you do for year 1, you do for year 2, you do for year 3. For example, I will just say standard deviation I've computed for the project. I will then do 1 plus cost of capital raised to power year 1 plus the same standard deviation over 1 plus cost of capital raised to power power 2, which is discount factor of year 2, until you get to the final year. Let's say this is the final year. Okay. So this would then be 1 plus the cost of capital raised to power the final year. So all this, the denominator are your discount factor. So because instead of me to be doing it one by one, I will just calculate annuity factor, since the standard deviation is already is a constant figure. All right, so I don't need to be doing this primary school. It's a waste of time when I can easily calculate my annuity factor and multiply with the standard deviation. That will be fine for me. All right, so this DT, the standard deviation, is the one you are going to calculate as the square root of summation of P of x minus x bar square. So after you have determined this standard deviation, you then go ahead and calculate the standard deviation of NPV. So that's basically what you need to do. Okay. So that is as per that. Of course, what do you mean by DT? DT is the standard deviation computed. In most cases, it will not be given to you. But if you are given, that means that's your luck. Okay, that's your luck. However, so you are the one that will compute this standard deviation. You compute it using this other formula. The regular formula, the formula you have, where did I put itself? Okay, it's up there. Anyway, so I've already shown you the formula. This is the formula here. The dt is equal to summation of p x minus x bar square root. So that's the dt. Then the dt square is the variance. Oh, I don't even need, I've not done the other part. Now, this is for all my explanation so far is for the mutually dependent cash flow. If you are now asked to calculate independent cash flow, okay, independent cash flow cash flow is a standalone cash flow in which the events of each year are the same. Okay, I repeat, independent cash flow is a standalone cash flow in which the events in each year are the same. Let me put it down somewhere for you. Oh, let me just put it by the side. Oh, that one has occupied. I don't want to clean it up so that you can see it. Okay, let me just put it here. Independent cash flow is the one, or it's a standalone cash flow. It's a standalone cash flow. In which the events of each year is different. Okay, so once you are given a cash flow that is different for each year, so that means they are standalone cash flow. So where you are given a standalone cash flow and you are asked to calculate standard deviation of NPV, then in that case, standard deviation of NPV standard deviation of NPV will be computed as square root of variance of each year over 1 plus R raised to power 2t. Okay, raised to power 2t. So that will give you the standard deviation of expected NPV. Okay, so I was trying to explain the variable the other time. dt is the standard deviation computed. dt square or d squared t. This one's supposed to be d squared t. All right, which is the variance of each year. All right, then t is the time period, n is number of years, r is the company's cost of capital, the annuity factor. Okay, so that's as per that. So these are the three methods or three formulas that you can use to compose standard deviation. Here is the first formula. You use this first formula to calculate standard deviation if in the question you are just asked to calculate standard deviation, regular standard deviation. Then the second one, you use the second formula to calculate your standard deviation If in the question you are given mutually dependent cash flow, and I said that mutually dependent cash flow is the one in which the events in each year or the events of each year are the same. When the same events affect all the cash flows, that means they are mutually dependent. Then the third formula is where you are given an independent cash flow. And I said that independent cash flow is a standalone cash flow in which the event of each year is different. Okay, when you are given different cash flow for each year, that means they are independent cash flow. All right, so that's that. Finally, let's talk about coefficient of variation. The coefficient of variation is also a statistical measure of relative dispersion. Remember, standard deviation is an absolute dispersion, but coefficient of variation is a relative dispersion and is a measure of spread about mean value. Coefficient of variation measures the risk associated with a project. All right, coefficient of variation measures the risk associated with a project. And then the higher the coefficient of variation, the risky the project. Again, where two or more projects are being considered, any project with a lower coefficient of variation should be selected. However, in a situation whereby different projects with varying sizes, okay, different projects with varying sizes or useful life are being considered, standard deviation may not produce optimal solution. In this circumstance, a more relative measure of dispersion should be used to analyze the risk, all right, which is coefficient of variation. Okay. Now, how do you compute coefficient of variation? The formula to use for coefficient of variation will depend on the standard deviation and the expected value that you have computed. If in the question you are asked to calculate ordinary standard deviation, the first formula, if in the question you have calculated standard deviation using this same formula I gave you here, this same formula here, and you have to calculate expected value, okay, and you have to calculate expected. Let me show you separately. Let me look for a space. Now, I said the coefficient of variation you are going to calculate will depend on the standard deviation and then the expected value you have computed. For example, if in the question you have calculated standard deviation, okay, you have calculated standard deviation as square root of variance. And you know, variance is summation of probability of x minus x bar square. You have calculated standard deviation using this formula. You have also calculated expected value. Expected value is summation of probability of x. So you have calculated standard deviation and expected value using the two formula I'm showing you right now. And you are now asked to calculate coefficient of variation. In this case, my CV, my coefficient of variation will then be equal to standard deviation divided by expected value. But if in the question you are asked to calculate standard deviation of NPV, you have calculated standard deviation of NPV using any of the two formulas. That is, I've calculated standard deviation of NPV using either this formula, okay, over 1 plus r raised to power 2t square root, or you have calculated the standard deviation of expected NPV using standard deviation multiplied by annuity factor. And in the question, examiner asks you to calculate expected NPV. Okay, you have calculated expected NPV. So, and you are now asked to calculate coefficient of variation. In that case, my coefficient of variation will then be equal to, let me remove this. CV will then be equal to standard deviation of expected NPV over expected NPV. So you see the difference between the two. So depending on your coefficient of variation is dependent on standard deviation and the expected value you have previously computed. All right. So watch out for the two. All right. So at this moment, let's have an illustration. Before we move on, any question for me? Any question? If none, then let's proceed to calculation. All right. Let's see. Yes, let's have illustration number 5. We are going to try two. One for where we have mutually dependent and the other one where we have independent cash flow, so that you see the way we are going to treat it. All right. Yes, I need one of you to read illustration number 5. Tonkpolo Limited. Who is helping us? Yes, who is helping us?
Okay. Lesson 5.
Okay.
Okay. Lesson 5. Tompolo
Okay.
Limited is considering whether to invest in a project which will entail immediate capital expenditure on equipment worth 40,000 naira. The expected sales volume from the project are given below. The unit selling price is 15 naira. Variable cost per unit is 9 naira. Once sales are established at a certain volume in the first year, they will continue at that same volume in the subsequent years. The useful life of the project is 6 years, and the equipment would be sold for 5,000 naira after the end of the project. The company's cost of capital is 10%. You are required to calculate 1. The expected net present value of the project. 2. The standard deviation of NPV. 3. The coefficient of variation.
All right, thank you. So you want to calculate expected NPV of the project. What are you supposed to do? First thing first, you need to calculate expected value. Then you calculate expected NPV. That is, you are supposed to use your expected value to go and compute NPV. The result is known as expected NPV. The second part, you have to calculate standard deviation of NPV. Now that you want to calculate standard deviation of NPV, you know that you have two different formulas that you can use to calculate standard deviation of NPV. I will therefore go to the question and check, am I given mutually dependent cash flow or independent cash flow? So I will identify the nature of my cash flow. Once that is done, then it will tell me which of the two formulas that I should use to calculate the standard deviation of NPV. Then number 3, you have to calculate the coefficient of variation. Since I've been asked to calculate the expected NPV and the standard deviation of NPV, therefore, I will use the second formula for my coefficient of variation. So without wasting more time, we need to go and calculate expected NPV. Now, for us to be able to do this, when you look at this question, we don't have cash flow. We are not given cash flow in the question. We are only given probability and units. You can't just multiply probability with units. Therefore, you need to go and calculate cash flow. How am I going to get my cash flow? Because I need to multiply probability with the cash flow. Since I'm not given cash flow, that means I need to go and work it out. How do I calculate my cash flow? I will go back to the question. You can see in this question, you are given selling price. You are also given variable cost. That means I need to calculate contribution. Once I have my contribution per unit, I will then multiply with the number of units. It will give me the cash flow. Once I get the cash flow, I will multiply with the probability to get the expected cash flow. Once I get the expected cash flow, I will then go ahead and calculate the expected NPV. That's all I need to do. It's as simple and straightforward as that. Okay? Now, let me stop sharing this and move to the working note quickly so that we can complete the two illustration I have for you under this. Okay. Solution to illustration. I think that's illustration number 5. Yes. Illustration 5, page 64. So the name of the company is Tompolo Limited. Now, we want to calculate expected NPV. You can't just go ahead and calculate expected value. So expected NPV. There are stages. There are steps we are supposed to carry out. So the first working what we do is to calculate expected value and variance. So I would then say expected value and variance. We match the two together in a table. All right. Let me first thing first do my working since I'm not given cash flow. Okay, this should be for, okay, let me do it this way. This should be for calculating expected net present value. Then after that, I can do the second requirement says we should calculate standard deviation. So our standard deviation will be here. Then coefficient of variation. So let's say our workings will start from here. Let me just manage here. So working number 1, I want to calculate contribution. Why am I calculating contribution? Because in the question, I've been given selling price and variable cost. So that means I need to calculate contribution. Therefore, contribution equal to selling price minus variable cost per unit. So according to the question, selling price is 15 naira. Variable cost is 9 naira. Therefore, contribution per unit is 6 naira. Now that I have the contribution per unit, I need to go and calculate total contribution. To get the total contribution, I will create a column for sales volume. Okay? I will create a column for units, contribution per unit, then total contribution. Give me the number of units. The first one is 2,000.
18.
1,800.
15.
Okay.
25.
And then
1,000.
1,000. So contribution per unit is 6 naira. We then multiply to get the total contribution. Here is 12,000. Here is 10,800. Here is 9,000. Here is 15,000. And then 6,000. So these are now that we have the cash flow, we can then proceed to calculate the expected cash flow. All right. To get the expected cash flow, I'm going to marry expected cash flow and variance together in a table. So I would then say working number 2, expected cash flow. Expected cash flow and variance. You need to calculate variance because of standard deviation. All right, so instead of doing this in different table, so you can use one table to do it, to calculate it, since it's a working. So to get the expected value, you are supposed to remember, expected value, let me put it there. Remember, expected value is equal to summation of probability of X. That is, you are supposed to multiply probability with the cash flow. Also, variance, denoted as D square, is computed as summation of probability of X minus X bar squared. So I want to expand the formula of variance. So we are starting with the probability, okay? Then we have the cash flow. Probability is P. Let me write this. Probability, cash flow. Then the expected value. Expected value. Okay. So probability is P. Of this table will be sufficient for me. Let me reduce this. Let me shorten it. Expected value. Probability is P. Cash flow is X. Expected value is probability multiplied by cash flow. Then to now get the variance, you then say cash flow minus expected value. Cash flow minus expected value square. Then probability of cash flow minus expected value square. All right. According to the question, what's the probability of the first probability?
0.15.
0.15,
0.2.
0.20,
0.35.
0.35,
0.1.
0.1,
Then 0.2.
0.20. These are the probability. And then we have calculated cash flow. The first cash flow we calculated was 12,000, followed by 10,800, 9,000, 15,000, and then 6,000. So to now get the expected value, you are supposed to multiply probability with the cash flow. What's the 15% of 12,000?
1,800.
1,800. Then this one will be 2,160. 0.35 of 9,000 will give us 3,000 watts. 3,150.
150.
Okay. Then here will be 1,500. Then the last one will be 1,200. Add up the expected value. Add up the expected value. What do you have?
$9,810.
9,810. 9,810. That's the expected value, X bar. All right. So, like I said, at all time, your probability must be equal to 1. Please, if your probability is not equal to 1, you have to make it equal to 1. At times, it may be a typo error. So, when you're in an exam hall and you face similar situation, all you need to do is to call one of the invigilators and explain, sir or ma, the probability in this question is not equal to 1. What do we do? The invigilator may tell you that, hold on, let me find out. If they're able to reach out, they will come back to you. If not, they will just announce. You can treat it the way you like, or they will tell you, exam invigilator will tell you that. After all, that's not the only question you have there. You can keep the, you can leave the question and go to another one. All right. But if you still want to solve the question, in that case, you need to make an assumption. It may be a typo error. Let's say, for example, the probability given to you is 0.95 instead of 1. Okay, you are given, or when you add up all the probability, you got 0.95 instead of 1.00. In that case, because you got 0.95, that means you cannot have optimal solution. In that circumstance, you need to make an assumption. You can make the last two number. Let's say, for example, this 0.20, which is the last one, let's say, for example, is 0.15. By the time you add it up, it will give you 0.95. So to now make an assumption, what you are supposed to do is to make it equal to 0.20. You then say, note, the probability given in this question is 0.95 instead of 1. Therefore, it is assumed that the last probability is 0.20. So you have told the examiner how you treated the number, your challenges, and how you are able to resolve it. All right? But you can't just make assumption without stating it. So that is as per that. At times, because you can imagine you have a very cheap question, and because due to typo error, you could not continue, you are stopped. So in that case, you need to make an assumption. Let's move on from here. Now, we want to determine the variance. Okay, so to get the variance, we need to expand the table. Here is the variance. So to now get the variance, this one is x minus x bar. Therefore, 12,000 minus 9810, what you get? That's 38
2190.
21.
90.
Okay, 2190. 2190. 2190 square.
Four seven nine
4,000,797
600
what?
6100.
100 multiplied by probability of 0.15.
100 796 100
796, yes.
719 415
719
415.
415. Okay. Then the second line, 10,800 minus 9810. What you get?
990
990 square.
980 100
980 100 multiplied by probability of 0.2.
39204
39204. Okay. Then, no, take it. Are you sure it's 39204?
let me check again.
196020.
Okay.
Okay, 196020. Sorry.
196.
Apologies.
It's okay. 196020. Okay. Then the third one, the third line, 9,000 minus 9810
810
minus 810 square.
656 100
656 100 multiplied by 0.35 probability.
196830
196830.
Okay.
No, it can't be. Well, it's possible.
229635.
Don't they sleep for?
Wumi, are you sure you are not seeing why?
I'm beginning to see why
So you say it's two words?
229635
Yeah.
635, okay. Then 15,000 minus 9810.
5190.
5190 square.
26.
26 million.
936,100.
26.
936,100.
936.
Okay. Then multiply by probability of 0.1. This will give us 2 million. Let me write that down. 2,693,610. 610. Okay. And the last one, 6,000 minus 9810 will give us minus 3810. Minus 3810 square. 14 million watts.
516,100.
516,100 multiplied by 0.2. 2,000,920.
03220.
So add up the variance, add up all the figures. Okay. 6 million. Seven.
The last one. 6741.
Okay.
6741.
900.
900. So that's the variance. That's the variance. So to now get the standard deviation under this, to get the standard deviation, I would then say standard deviation, which is square root of variance. Okay, and you know variance is P, summation of probability of X minus X bar squared. So in this case, our variance would then be equal to 6,741,900. So when you put it in your calculator, you get the variance 6,741,900. Then you press the square root to give us 2. We have 2,597.
96.52.
That's 97. Okay. 2,5. So that's the standard deviation. So now that we have calculated variance, we have calculated expected value as well as a standard deviation, we can then proceed to answer the question properly. All these things we've been doing since are just workings. So to now get the expected NPV, okay, so we are going to use the expected value we've computed to calculate the NPV using the same formats. Create a column for year. If you like, you can include a column for description of items. Then you have cash flow. We have discount factor. Cost of capital given is 10%. I think, let me confirm. Cost of capital.
Confirm. 10%.
Okay, it's 10%. All right. Then we have the present value. Year 0. Our expected value is they are mutually dependent cash flow. So for year 1 to year 6 is the same amount, 9810. Therefore, we need to calculate annuity factor of year 1 to 6. We are also given scrap value. So here is initial outlay. We have cash flow. Then we have scrap value. Initial outlay, according to the question, I think it's 40,000. Let me confirm.
Yes, 40,000.
Yes, 40,000 naira. So here is 40,000. Our annual cash flow, expected value, 9810. Then we have scrap value of 5,000 naira. Then I need to calculate annuity factor of year 1 to 6 at 10%. What do you have? That will give us
355.
355. Thank you. Then what's the discount factor in year 6 at 10%? 0.5 what?
64.
0.564. So we need to calculate the present value. Multiply. Here is 40,000. This one should be 2820.
42,722.
4272.
722.5.
Okay, that's 723.
Yes, sir.
723. So add it up. This should give us 5543. Yeah, I think that's it. That should be correct. 5543. Okay, so that's it. This is the expected NPV. Now that we have computed the expected NPV, we then answer the second requirement. The second requirement is to calculate standard deviation of NPV. So before I put down my formula for calculate standard deviation of NPV, I need to check from the question, what is the nature of the cash flow? Am I given mutually dependent cash flow or independent cash flow? Of course, the cash flow of year 1 to 6 are the same. That means they are mutually dependent cash flow. You can see in this question, the examiner did not tell you they are mutually dependent. You must be able to deduce. You must be able to infer from the question the nature of the cash flow. All right? Even though the examiner has told you in the question that there is a place where the examiner mentioned that, yes, the paragraph after the table, you are told that once sales are established at a certain volume in the first year, they will continue at that same volume in the subsequent years. That means they are mutually dependent. Okay, so that's that. Then second requirement, we have to calculate standard deviation of NPV. I would then say calculating standard deviation of NPV. So to calculate standard deviation of NPV, like I said, the formula to use will depend on whether cash flows are mutually dependent or we are given independent cash flow. So since we are given mutually dependent cash flow, I will just say standard deviation multiplied by annuity factor. So we have calculated standard deviation to be 2597. Our annuity factor is 4.355. So multiply. What do you have here? What do you have? Minister of Finance, are you still there?
$11,310.
11,310. So that's that. Then number 3, you have to calculate coefficient of variation. So calculating coefficients of variation. CV. The coefficient of variation, the formula to use for coefficient of variation will depend on the standard deviation that you have computed. In the question, we have calculated expected NPV. We also calculated standard deviation of NPV. Therefore, coefficient of variation will be standard deviation of NPV over expected NPV. Okay, so in this case, I would then say CV equal to 11,310 divided by 5543. So CV is equal to 2 point what?
2.04.
2.04. That's the end of the question. It's as simple as that. Just know what you are doing. All right? It's as simple as that. This kind of a question will come as 15 marks, maximum 20 marks, depending on how the question is structured. Okay? All right. So let's have one more before we close, so that we know that we are done with expected value, standard deviation, coefficient of variation. In our next class, we just do simulation, sensitivity analysis, and if possible, we do a decision tree. So let's have one more illustration under this quickly. All right, let me stop sharing this. Okay, let's solve illustration number 4. This one has to do with independent cash flow. Who is helping us to read? Barcelona. Yes. Augusta, are you there? Some of you are just attending classes by proxy. You are you just join the class. You won't see anything. Read, you will not read. Eh? Augusta, are you there? Read for us.
Okay. Barcelona Limited has an investment proposal that has the following probability distribution of return. The table assumed correct.
Okay.
The events of each year are independent of other years. The outlay on the project is fixed at 22,000 and the appropriate discount rate figure is 10%. Required, calculate the expected net present value. 2, the variance of return in each of the years. 3, the standard deviation of the net present value. 4, the coefficient of variation.
All right, thank you, Augusta.
You're
So you
welcome.
can mute. Yeah. So we want to calculate expected net present value. Again, just the same way we calculate you calculated the first one without wasting time on this, so that we can complete the question on time. Let me switch. Solution to illustration 4. Still on page, is it 54? Let me confirm again. 63. Solution to page 63. All right. So the name of the company is Barcelona Limited. So examiner wants you to calculate expected NPV. Like I said, you can't just go ahead and calculate expected NPV. You need to first of all calculate expected value for each year. You will notice that in this question, the cash flow of year 1 is different from the cash flow of year 2 and 3. That means they are independent cash flow. So in this case, we are going to calculate expected value for each year, variance of each year. Then you now calculate expected value of NPV. You calculate variance as examiner asks you. Then we calculate the standard deviation and the coefficient of variation. So without wasting more time, we are starting. Let me change the approach. Let's calculate expected value. So I will say expected value and variance. So we do for each year, calculate expected value and variance for each year. So let's say this is for year 1. Okay. So we create a column for probability, cash flow, expected value, X cash flow minus expected value, cash flow minus expected value, then square, probability multiplied by cash flow minus expected value square. This is P, this is X, this is P of X, okay? All right. So give me the probability of year one, please.
0.2,
Yes.
0.4,
Uh-huh.
and 0.4.
Okay. Let's be fast a little bit so that we can complete in record time. Then the cash flow. Cash flow.
6,000,
Uh-huh.
8,000,
And then,
9,000.
so to now get the expected value, 20% of 6,000 will give us 1,200. 40% of 8,000 will give us 3,200. Then 40% of 9,000 will give us 3,600. You add it up. This will give us 8,000 total. This is expected value. Now, to get the variance, you are supposed to multiply. To get the variance, this is variance. 6,000 minus 8,000 will give us minus 2,000. Minus 2,000 squared will give us 4 million naira. 4 million multiplied by probability of 0.2. We have 800,000. Okay. Chinozo, please mute. You are the one making noise. Read, you will not help me to read. You are distracting my class. Okay, 8,000 minus 8,000 is 0. 9,000 minus 8,000 will give us 1,000. 1,000 square, 1 million naira. 1 million multiplied by 0.4 will give us 400,000. When you add it up, 1,200,000. That's the variance of year one. We then do for year two. Okay. In year two, we have probability, cash flow, expected value, x minus x bar, x minus x bar square, then probability of x minus x bar square. Give me the probability of year two.
0.5,
Uh-huh.
0.5.
0.5. Here is 1. Cash flow, please.
8,000,
And then
12. I guess it's
1,000.
12,000. Yes.
You guess, Abi, it is. Check.
It's 12,000.
Okay. So 50% of 8,000 will give us 4,000.
4,000.
50% of 12,000 will give us 6,000. So you add it up. Expected value is 10,000 for year two. So to now get the variance, we need to expand. 8,000 minus 10,000 will give us minus 2,000. Minus 2,000 squared will give us 4 million. 4 million multiplied by 50% will give us 2 million. The second one, 12,000 minus 10,000 will give us 2,000. 2,000 squared is 4 million. 4 million multiplied by probability of 0.5, 2 million. When you add it up, that's 4 million. So we have calculated variance for year two. We are moving to year three. I hoped. What's the probability of year 3?
0.3,
Uh-huh.
0.5,
Uh-huh.
0.2.
0.2. Okay, I want to see if this table will be sufficient. Okay, let's manage it. So probability, cash flow, expected value, x minus x bar, x minus x bar square, then probability of x minus x bar square. Let's see if this will be sufficient. So it's 0.3, right?
Yes, sir.
0.5, then
0.2.
0.20, which is equal to 1. Okay, let me repeat this.
7,000,
7,000,
11,000,
11,
17,000.
17,000. Let me complete my table. So 30% of 7,000 will give us 2,100. 50% of 11,000 will give us 5,500. 20% of 17,000 will give us 3,400. When you add it up, this should be 11,000. All right, let me write that 11. Okay, so 7,000 minus 11,000 will give us minus 4,000. Minus 4,000 square will give us 16 million naira. 16 million. 16 million multiplied by 30% probability. That will be
4.8 million.
4,800,000. Okay, so 11,000 minus 11,000, 0. 17,000 minus 11,000, 6,000. 6,000 square, 36 million. 36 million multiplied by 0.2, 7,200,000. When you add it up, that's 12 million. So at this point, we can now answer the question appropriately. So requirement number 1, we have to calculate expected NPV. I would then say calculating expected net present value. Create a column for year, description of item, if necessary, then cash flow, discount factor. What's the cost of capital given?
10%.
10%. So year 0, 1, 2, 3. Cash flow, initial outlay, then cash flow. Cash flow of year 1. Sorry, before that, initial outlay is, what's the initial outlay? 22,000, right?
Confirm, sir.
2,000. Okay. Then expected value in year 1, we calculated 8,000. Year 2, 10,000. Year 3, 11,000. Discount factor for year 1 at 10%, 0.909, 826, 751. Then we multiply to get the present value. Okay, this will give us 7,272. This one will be 8260. 11,000 multiplied by 0.751. What you get? 8261. 8261.
261.
Okay. 8261. Oh, Chinozo gave me value. That's good. So Chinozo, because I talked now, so that's good. You are improving. You are improving. That's keep it up, please. Don't be sleeping in my class. You have to say something. When you hear something, then you say something. That shows you are participating. Okay. All right. So final answer is what? 7272 plus 8260 plus 8261 equal minus 22,000. What you get? 1,793. So that's the expected NPV. The expected NPV is 1,793. Then number 2 requirements, you have to calculate variance. So we've already calculated the variance, just put it in a table for proper presentation. So create a column for year, then variance. Variance of year 1, we got year 1, we got 1,200,000. Let me go back. So we calculated, this is for year 1, year 2, 4 million, year 3, 12 million. All right. So here is 1,200,000. Year 2, 4 million. Then year 3, we have 12 million. So that's that. Requirement number 3. We are to calculate standard deviation of NPV. High. Standard deviation of NPV. To get the standard deviation of NPV, I need to go back to the question, what is the nature of the cash flow? Am I given independent cash flow or mutually dependent cash flow? Because the cash flow of year 1, 2, 3 are different. That means they are independent cash flow. They are standalone cash flows. So since they are independent cash flow, then the standard deviation of NPV will be calculated as the variance in each year over 1 plus r raised to power 2t. Find the square root. Okay? So that's that. I would then say standard deviation of expected NPV equal, let me write this. Standard deviation of expected NPV equal variance of year 1 is 1.2 million divided by discount factor, our cost of capital is 10%, therefore 1.10 raised to power 2 times year 1 plus 4 million divided by 1.10 raised to power 2 times year 2 plus 12 million over 1.10 raised to power 2 times year 3. Then you find the square root of everything. Okay? So standard deviation of expected NPV will then be equal to 1.2 million divided by 1.1 raised to power 2 will give us 1.21 plus 4 million divided by 1.1 raised to power 4 will give us 1.4641 plus 12 million divided by 1.1 raised to power 6 will give us 1.771561. Please confirm for me. Are the denominators correct?
Yes, sir.
Correct, sir.
Okay, then. So at this point, I just need to get the final answer. All right. I don't need to be doing it one by one again. So in this case, I will just say standard deviation of MPV equal to, this is what you are going to do. Bring out your calculator where you are. Follow me. So just open a bracket from your calculator. Open a bracket. The first cash flow, which is 1.2 million, 1,200,000 divided by 1.21. Close the brackets, plus open another bracket, 4 million divided by 1.4641. Okay, close the brackets, plus open another bracket, 12 million divided by 1.771561. Close the brackets, press equal to, we have 10,497,476.592 whatever. So the answer you have in your calculator, just press the square root. So that will give you 3239.98. Okay, so this is 3239.98. Let me write everything. Three, 39.98. So you round your number, okay? That will give you 3240. So standard deviation of MPV is equal to 3240. That's it. Finally, number 4. You have to calculate coefficient of variation. CV. So coefficient of, like I said, the formula to use to calculate your coefficient of variation will depend on the standard deviation and expected value you have computed. So since we have calculated standard deviation of MPV, therefore coefficient of variation is the standard deviation of MPV over expected MPV. All right, so CV will be equal to standard deviation of MPV, we calculated 3240. Then expected value, we calculated 1793. Therefore, CV is equal to 1.81. So that's it. It's as simple as that. Let me know if you have any question for me. Some of you have disappeared. No worries. It's understandable. All right. So let me know if you have any question for me so that we can close the class. Now, so far, under risk and uncertainty, we have discussed expected value method, standard deviation, and coefficient of variation. So in our next class, by the grace of God, we are going to have sensitivity analysis. After that, we are going to do simulation. Then finally, we are going to do decision tree. All right, so those are the three scope we have outstanding under risk and uncertainty. So yeah, let me know if you have any question for me so that we can close the class. Okay, so in the absence of no further question, I want to say good night, everyone. Appreciate your patience and their understanding. See you next week by the grace of God.
Good night, sir.
All right, good night.
Good night, sir.
Yeah, Dami, good night.
Good night, sir.
Augusta, everyone.
Nice, sir.
Nonso, good night.
Good night, sir.
Yeah, good night, bro.